If you told investors a year ago that a small fuel cell company would be fielding 4 gigawatts of power proposals from AI hyperscalers, most would have laughed. But FuelCell Energy's Q2 Fiscal 2026 earnings call just changed the conversation, and there are 10 things every investor needs to understand right now. Stick around, because number 1 is the one Wall Street is still sleeping on. Coming in at number 10, FuelCell took a $42.6 million non-cash impairment charge this quarter to upgrade its Groton, Connecticut installation, a microgrid serving a U.S. Navy nuclear submarine base. This wasn't a failure. It was a deliberate decision to replace legacy hardware with the company's current generation 2.5 megawatt power blocks, standardizing the entire fleet and ensuring maximum reliability for one of America's most critical military assets. Strip that charge out, and core operating costs actually fell year over year. At number 9, 2 carbon capture modules are literally in transit right now, en route to ExxonMobil's Rotterdam facility, with delivery expected in June. This collaboration with ExxonMobil's low-carbon solutions business is moving from lab to real-world proof point, and management believes the market hasn't yet priced in the massive total addressable market for point-source industrial emissions reductions. Number 8. South Korea continues to be a reliable revenue engine. Ongoing module deliveries to Gyeonggi Green Energy, plus upcoming shipments under the Gyeonggi contract, are expected to drive consistent product revenue in the back half of fiscal 2026, providing a tangible near-term earnings catalyst while the company converts its monster domestic pipeline. At number 7, the adjusted EBITDA loss narrowed 12% year over year to negative $17.1 million. That improvement came from genuine cost discipline, not accounting tricks. Excluding the Groton impairment, core operating expenses declined, and management is confident existing cost structure will generate significant operating leverage as revenue scales. Number 6. FuelCell ended the quarter with $440.9 million in total cash, is essentially debt-free, and has no near-term debt maturities. Post-quarter end, another $52.9 million was raised via the ATM program. That balance sheet gives the company runway to execute its expansion without being forced into dilutive financing at bad prices. At number 5, Torrington manufacturing capacity is being expanded from 350 megawatts to 500 megawatts per year at a total cost of $200 to $275 million. Critically, management committed to expanding capacity in lockstep with contracted backlog, not ahead of it, which is exactly the kind of capital discipline investors should want to see. Number 4 is the newly launched 12.5 MW FuelCell Energy Block. This isn't a collection of small units bolted together. It's a utility-scale architecture scaled out using the same proven stack. It lets data center developers buy power in phases rather than overbuild up front, improves economics by spreading balance of plant costs across a larger block, and has already accelerated customer conversations since its March debut. At number 3, management was unambiguous. The path to adjusted EBITDA profitability runs through approximately 100 megawatts of annualized production. That target did not change despite the capacity expansion announcement, meaning the profitability inflection point is tied to contracts, not factory size, and it could arrive well before Torrington reaches full capacity. Number 2 is staggering. The submitted proposal pipeline grew more than 250% in a single quarter, from roughly 1.1 gigawatts to over 4 gigawatts. Even more telling, average proposal size doubled from 65 megawatts to 130 megawatts in just 3 months, reflecting the scale at which hyperscalers are now engaging. These aren't tire kickers. These are infrastructure decisions measured in hundreds of millions of dollars. And the number 1 takeaway, 89% of that 4 gigawatt pipeline is AI data center demand. FuelCell's native DC output, thermal integration for absorption chilling, modular deployment, community-friendly permitting profile, and proven 23-plus-year operational track record make it uniquely positioned to solve the power crisis that is already bottlenecking AI infrastructure build-out. The grid can't keep up. Permitting timelines are years long. FuelCell can potentially deploy where others can't even get started. If the company converts even a fraction of that pipeline into contracted backlog this fiscal year, the investment thesis could reprice dramatically. That's the number 1 reason this earnings call deserves your full attention. If you found this video helpful, don't forget to subscribe for more earnings analysis from Earnings Central.